Welcome back to Let's Talk Tax. I'm Dave McGuire. When people hear specialty tax, they often picture billion-dollar corporations with teams of tax attorneys, but that's not reality. Some of the biggest opportunities we see come from privately held manufacturers, distributors, contractor, healthcare practices, and family businesses. Today I'm joined by Mike Hammel. Mike, thank you for joining us.
Thanks, Dave.
So Mike, let's play a quick little game. And let's talk about certain businesses and whether or not specialty tax would be a good opportunity. You can tell me if this client would be too small or maybe doesn't fit at all.
Okay.
So what about a 40-person manufacturing company?
Still fits.
Family-owned construction company?
That fits as well.
Software startup?
That one fits as well.
A dental practice opening a second office?
It's a key thing there, but yes, that fits as well.
A machine shop exporting products?
It fits too.
So sounds like all of them fit, really depending on what they're doing. And I think the critical thing that you kind of pointed out, as I mentioned the dental practice opening a new office, it's what are they doing and does it fit within those different opportunities to potentially save some taxes?
That's exactly right. I think when you look at specialty tax, it's not Amazon, Apple, these big corporations, because everybody sees that in the news lines and they see it when it comes out on a news article that they're investing billions of dollars or millions of dollars to add jobs and add people and add various, basically put money back into the community. But when you look at each one of these that you've just mentioned, take the first one, 40-person manufacturer. There's a bunch of manufacturing businesses spread throughout the United States. And when you look at specialty tax, they could look at an R&D credit. Maybe it's $15,000, $20,000, still a lot of money to a closely held business when you look at investing back into the business, investing in their growth, right? So specialty tax is not just for large, really big corporations. It's for mom and pop shops that are in the local community that have been there for, 20, 30, 40 years. And maybe there's a little bit of growth year over year, but it's meant for everybody.
Well, it seems like when we went through those, they don't all fit the same thing. So you mentioned that 40-person manufacturer. Well, maybe that's an R&D credit. Maybe they're expanding. They get some cost seg opportunity. Maybe they need a property tax reduction on their property tax assessment. Whereas a dental practice, that's probably just going to be cost seg or something else.
Mm-hmm.
But I think it really, you kind of keyed in on it. It really depends more on what they're doing versus the size of the company. And too often we try to pigeonhole people based on the size, not what they're doing, because they might not always fit the same scenario. Mike, when you're sitting with a CPA firm and you're kind of working through, because you meet with CPA firms every week.
Mm-hmm.
So when you're talking to them, they're talking about a new client. What are some of the things that make you go, you know what, that client may have an opportunity?
Great question. I think when we sit down with CPA firms, I really like to get an understanding of what the client does, where they're located, what they're investing in, kind of what their business plan or their growth plans look like over the next couple of years. Pretty basic question when you sit there and talk to a business owner. Hey, what do you plan on doing in the next 2 to 3 years? Where are you going to grow? What do you guys do? Walk me through it at a high level. And so when we sit there with business owners, I usually start with whether it be cost segregation, whether it be R&D tax credit or international tax work. It's tell me a little bit more about your business. How are you founded? What made you start the business? Kind of start back to square one. Once you get a business owner talking, you've been in a lot of those meetings, they like to talk about what they do. They're proud about what they do. And so when you start with that question, you get better understanding of exactly what their goals are. And the key part that we always talk about here is trying to get an understanding of more listening than talking, right? So it's sitting back, observing, listening, asking those questions, because once a business owner starts to get rolling, we get more details, we get more information. Now we can properly advise based on some of the things that they might be investing in.
So sounds like it has more to do with what they're doing versus the size. And when I'm hearing that, I never did you say the first question I ask is how large are they or what's their revenue? And I think it's a good thing to think about. I think about it on the real estate side, coming from the fixed asset side. People hear about real estate owners and they get fixated on the large scale real estate owners, but a lot of them are owning properties that maybe aren't that profitable. They're holding them for long-term gain. Maybe they've done a whole bunch of 1031 and they've eroded their basis. Yet the smaller company, the dental practice that buys a new $1 million facility people don't think about. But yet, if you can get them a $200,000 tax deduction on that new $1 million facility, that goes straight against the income of that dentist and could actually mean more for that individual taxpayer than a cost seg study could do on the Empire State Building that's worth $100 million.
No, it's exactly right. I think it all comes down to, most people try to put a revenue amount tied to a specific credit amount or a deduction amount that they're entitled to based off size. But we might work with a tech startup, right? So it could be 5 to 10 people all qualified. Well, they could be looking at a $40,000, $50,000 tax credit in those examples. Well, they're not making money. So now we can look at offsetting payroll taxes. So I think when you look at size, everybody just wants to see large investment. That's one of the myths that we see a lot with like location advisory right now is you think you need to invest millions and millions of dollars and add all these jobs in order to take it. But we talk with closely held businesses that invest $1 million to $2 million over a couple of years and hire 15, 20 people. It makes sense, right? So it's all relative to the individual and the business, not just, hey, I need you to go out there and invest X number in order for you to take advantage of this credit or this deduction.
So what are certain keywords that you like when you're having a conversation? You're out on the golf course. You mentioned you played golf this weekend when we were kind of prepping for this.
I tried.
So as you're out playing golf with somebody and you meet somebody new, what are some of the key words that you're listening for in that conversation that trigger you to go, you know what, there might be an opportunity there?
Yeah, I think the biggest one is always understanding, like I said, growth is one, but when you look at their business, it's what are you guys doing? What kind of industry are you in? Where are you located? Okay. How many people do you have? Very rarely do I sit there and first question that comes up, how big are you? Tell me how much your revenue is, right? I hardly ever lead with that. It's more so getting an understanding of why they've been built, where they're located, how many people they have, what kind of products are you developing? If it's a product-based business, what are your goals, right? Are you guys sitting here and looking at maybe an acquisition of a business? Maybe maybe there's some transition in ownership right now that we would have to talk about what that potentially looks like. And so it's really just getting an understanding of their business as a whole. We always say, and we laugh about this on our relationship management team, is we always start conversations with, walk me through what you're doing, or at a high level, a 30,000 foot view, just tell me more about your business. How were you founded? What were you doing? And so those are a couple of things that I would sit there if we're just hanging around talking and they're having a conversation about, oh my gosh, my banker just called me and we're going through financing right now to go figure out how we're going to go, build a building. Okay. Well, there's a lot of things that come to my head when that happens. It's, hey, have you heard of specialty tax? Who's your CPA firm? Are they walking you through incentives, right? When you build that building, and then on the back end, there's depreciation plays on those. But if you're investing X, we can figure out what we can return and why.
It sounds like when you're talking to them, it's almost, you have to be curious. It's the, we were talking to Ben Worrell, who runs our location advisory practice earlier today, and he kept talking about he wants people to be curious. I don't know. It might be that he just watched Ted Lasso. Ted Lasso always says he wants people to be curious, but I think that's the key thing, is the curiosity as to what's going on in the business versus the easy questions. It's getting to know a little bit more.
And to double on that, I think you look at being an advisor. We always talk about having an advisor mindset. I think looking through being curious is one of the biggest pieces that helps people listen and identify those opportunities and honestly cut through the noise to figure out how we can help. So it doesn't have to be a small business. If it's a large business, great, right? If the larger the investment, the more you're going to get back in the form of a credit or deduction. It just depends. It's all relative again. But, in the CPA world, in the accounting space, when we're serving clients, I think everybody laughs when we're sitting up in a presentation and we say, well, it depends, right? Because it really, truly does. It's not a cliche, just back out of this question. It's the facts of the situation really, truly depend on a value that we could bring.
Well, and I think it brings up a good point, Mike, is that it's what fits the best scenario. And I was talking to Ben earlier, and one of the key things that we were talking about is how it's nice to be at a firm where we have multiple different service lines that we can look at. So when we're going in, we're not trying to fit a commodity to somebody that doesn't need it. And I know you've heard me talk about it. I talk about it quite a bit, that when you think of commodities, you think of a toaster oven. The way you make more money selling toaster ovens is you sell more toaster ovens. if you think of a cost seg study or an R&D study as a commodity, all you're doing is you're trying to pigeonhole that in and go, everybody needs to buy an R&D study. Everybody needs to buy a cost seg study. But by the curious conversation you were mentioning earlier, those question marks about, are you running out of space? What are you doing? Are you hiring? What are the things that your business is doing? You move away from that commodity and more back to the consulting nature that the CPA and the client needs to determine whether or not it's actually going to help them.
And I think it's also the cadence in which you do it.
Mm-hmm.
You know, I mean, we do it every day because that's just it's natural for us. Well, we have to help coach and educate CPA firms to saying you don't just do that twice a year. You know, you don't wait till tax planning to check in on a client and figure out what they're doing. This is an everyday routine, and the more you bake that into your everyday routine to ask more questions, be curious, trying to get to the bottom line, because if you're sitting there with a business owner that truly wants to grow, they're looking for you not only to help them maximize their investments and their growth plans, but also to match them up with people that can also help support in other areas. And so it's really, really important just to make sure that it's top of mind, right? Because that's how you either help them through a situation. If a client's doing something that maybe they're getting too far along in the process and you can kind of pull them back a little bit because you're having those conversations on a day-to-day basis, or it just helps kind of alleviate some of the pains that you might have down the road of saying, hey, I already did this, but what should I consider? It's like, well, we might be too far down the road in order to unwind that.
So when we're thinking about specialty tax, and obviously we think of specialty tax, we've got the R&D, we've got cost seg, global business services, location advisory, property tax. What's kind of some of the big misconceptions that CPA firms, when you meet with them, may have about that?
The biggest misconception is it's tied to revenue. You have a $100 million business, they should have a $100,000 tax credit. That's just not the reality. And so it always depends upon the makeup of a client, or whether what their team looks like, what they're investing in, whether it's a new product development on the R&D side, right? And then on the international tax side, you look at, clients always think, well, I'm not Amazon. I'm not a big corporation out here. International tax doesn't apply to me. But it applies, we see it every day with small businesses that are exporting products, right? They have issues there. Or they're like, hey, I'm going to buy a business, and they have 2 foreign subsidiaries set up right now. It's not a big deal. We don't have to really worry about having planning opportunities, but it's like, time out. We do. We need to worry about compliance. We need to worry about structuring. And also, on top of that, there's probably some intercompany transactions with transfer pricing. There's other considerations other than just sitting there saying, hey, just go buy this business. Mm-hmm. We need to make sure that we're part of that timeline to vet those out and make sure it makes sense from a business standpoint.
Well, the global business is a good example. I was talking to Greg, who runs that practice a week or 2 ago, and he was talking about a client. It was just a high net worth individual that the CPA firm was doing the return for. They went and bought a condo in Mexico and opened a bank account in Mexico, really just to pay the cleaning people. Mm-hmm. All of a sudden started forming bank account reporting issues. The CPA firm didn't want to handle it, so they needed somebody that could come in and assist them. And it's those type of situations occur more often than we realize, where a small change causes this cascade of opportunities or compliance risks that we need to be aware of. When you're going through and looking at where opportunities are and the potentially the magnitude of them, depending on the size of it, or the lack thereof, where people may think it is, what are some of the surprises that people run into?
Yeah, I think some of the surprises is just, a couple things. I think one is, when we look at helping or looking through client data and coming through all that stuff, I always harp on internally that, it makes sense to comb through a tax return when we get them, because a tax return can tell you not the whole picture, but a good story. So I'm always looking through those to make sure that we're bringing up new ideas, we're bringing up new opportunities in those situations. But one of the biggest misconceptions that I see right now, especially for business owners to get some cash back quick, is, you worked in it, you still work in it, but cost segregation. Thinking that you can only do a study the year the building's placed in service or the year that I buy it. Well, I could be sitting on a golf course, speaking of our recent example, and maybe that business already bought 2 buildings 3 years ago, or whatever the time frame might be, and they didn't do a cost seg study on it. Well, that's immediate deductions that they could take in that year of their filing their return, and we could speed up some of the deductions and get some cash to them. But that's a misconception because everybody thinks that you have to do a study the year you place it in service or you buy a building.
So in addition to kind of what services surprise people, and maybe not surprises about, but what's an industry where you've gone, man, because I got this job, I got to work with somebody in this industry or saw an opportunity here that I never would have expected 5 years ago?
I think right now is, I love government contracting. Okay. So, government contracting had some misconceptions to it around the R&D credit, just because when you look at the work that people are doing is technical in nature, it fits the R&D credit, but there's other mechanisms that we need to kind of talk about, contract language, making sure they're economically at risk in all those situations. And so we've seen a large uptick given what's going on in the political world today, but also just with wars and everything going on, we're starting to see more government contractors come to light. So now we're having more conversations around not only R&D. I can think of one that we had a couple weeks ago of a business owner just sat there and we're talking through the R&D credit, and he goes, man, what else do you guys do? Like, I need help because I'm growing. We're having all these new contracts. We don't only just want to invest in the government work that we have. We also want to commercialize some of our products. And so what should I be aware of? Because I don't want to do something and then on the back end say, oh, I forgot I can't get this deduction, or I can't get this credit, or I can't get this incentive because I already bought land, or in those situations. Yep. And so that is a very unique situation. We don't always see that from business owners. We usually find out on the back end. And so it is always good to be ahead of those type of decisions.
As we're thinking about this, I'm going to go through some examples, and you can tell me, obviously this conversation is about whether or not they're too small. So we know the answer is going to be none of them are too small, but what's the opportunity that comes to mind when I mention these? So let's say we got an $8 million manufacturer. They manufacture some type of widget, and they're expanding, buying new equipment, but they only do about $8 million in revenue a year. What's the first thing that comes to mind there?
Location advisory. You're buying equipment, right? So if we can get some type of abatement on the equipment, whether it be a sales and use abatement before they buy it. So think of purchase orders, right? So as they're going through that process, we need to make sure we're ahead of those type of investments. But that's not the only thing. Anytime I hear manufacturing, my head immediately goes to R&D, right? That's worth a conversation, because that to me is the low-hanging fruit. You're in manufacturing, you're building a product, you probably have some testing involved, so R&D makes sense. And the other part to it too is it does not hurt to ask the question, hey, do you own your real estate? Because most of the times they own the real estate, or they're investing in some type of improvement to the property. So now we've lent ourselves into cost seg. And if it's for production purposes, we could be looking at qualified production property. And so that one example of an $8 million manufacturer that's building products, which they would tend to tell us, and this happens all the time, hey, we do this every day. Well, that just means that your business overlaps with some of the credits and incentives that we can provide. And so there's not only just one practice line that always fits like a manufacturing business. I would say with most of the businesses that we work with, regardless of industry, you're going to find one and most likely two on every single opportunity that you deal with.
What about like a dental practice that's opening another location or expanding into multiple offices?
So if they own their real estate, we're looking at cost segregation, and then as they assess those properties, we're looking at real estate property tax appeal opportunities on the real property. So there's, again, back to my point, is there's two opportunities even on a dental practice.
One that comes up here is listed as scenario 5, and they said, what about a food manufacturer that's exporting to Canada? So they're not going over the ocean. Nope. They're just pushing some food up to Canada.
IC disc, which is basically an export tax incentive. And so anytime someone's exporting products, so I would think of multiple things. In my head is, if I hear someone saying we're exporting products into Canada, my first question is usually why, right? Give me some more context to it. And then we know we have an IC disc opportunity if it's, say the volume's there, say about $2.5 million in export sales. The other part is sometimes they have subsidiaries up in Canada. And so if they have an actual presence in Canada, so they're filing, they have an entity, whatever that might be, now we start lending ourselves into intercompany transactions. So there's transfer pricing that could potentially be there, as well as the compliance. And so international tax is obviously the biggest one. The funny one is when we're sitting in presentations and we're talking with CPA firms and we talk about IC disc, since it is an export tax incentive, we always have to remind people in the audience, hey, Canada and Mexico, you can actually include them. Those are not in the United States, right? And so having that perspective and just kind of making it known that it's anything in Canada, Mexico, across the pond, whatever that potentially could be, we have a qualified export.
And actually what's interesting, especially when we start talking about small businesses, I had a conversation with Greg earlier today, and he was talking about small businesses, maybe it's taxed at the corporate tax rate, but it's a family business. If they're exporting, they could have the individual owners own the disc because they're going to be being taxed at the top marginal tax rate. So they could have
it's like a wage replacement.
In a wage replacement, and then they could get a portion of their wages taxed at a much lower rate. Yeah. So I think the key thing is there's a lot of opportunities. I mean, we said family-owned food manufacturer. So you got disc, but it's a manufacturer. So are they expanding? Is there qualified production property? Or is there equipment? Is there growth opportunity? So I think it's important to be, the curiosity comes back once again, is what's going on with the business and where does it fit? Not how can we sell them something? It's where can we potentially help them by being curious about what they're doing?
Yeah, it's exactly right. If we be curious in those certain moments, now we know how to properly serve clients and then also how to match that deduction or credit up with the year that it makes sense. I mean, that's the key part. I think once you understand where they're going, where they're heading, we can match some of the other pieces that we do. And it's not just self-serving and saying, hey, here's this big credit, here's this deduction, let's do a project. It's no, let's match this up with your investment plans and your growth plans because we want to be fuel to that. We want to be a factor that helps you guys get to your ultimate goals.
Now, without saying any names, do you have any examples of a client that maybe people thought was too small, and then we were able to come in and help them because by working proactively like that?
I can think of a lot, and I think the biggest one, there's a couple that come to mind. One is in the software space, and they always thought that the software that they were creating wasn't going to meet some of the specification and qualifications because it was for their internal use, right? So they're building out new products, they're building out efficiencies internally. So there was an area that we could take the R&D credit, and they just thought it wasn't going to be big enough for them because they only had about 2 or 3 people that were doing development. 2 or 3 people that might not seem like a lot, but they were getting paid pretty well because they had some venture capital money that was poured into their growth plans. And so they were able to take that tax credit, even though they were producing a loss, and get about a $15,000 tax credit to offset their payroll. Immediate money back to them, immediate investment back into the business. And then we started talking a little bit more and said, okay, well, what are your plans? You're venture capital backed. There's obviously a growth plan. What does that look like? And then they're happy to sit there and explain, okay, in the next 3 years, yes, we might be 10 people today when you look at management and sales team and some of the development team, but we want to be 50, 60 people in the next 3 years. So now we have jobs. So location advisory comes into play. So there's so many other opportunities if we just sit back and go, okay, be curious, tell me a little bit more about what you want to do, and then we can start to figure out how we tactically help them.
And I think that's the thing. It's curiosity, and then how do we help them? I mean, when I said it, one of the ones that came to mind for me is we had a small company that had a very small R&D credit, but their income was always relatively low. Then when 174 hit, 174 caused it to look on paper that first year like they had almost $1 million tax liability because they had to add all that 174 back to income. But yet we were able to go in and look at a property they had owned for a few years, do a cost seg study, create a massive catch-up deduction, which offset a lot of that 174 expense. So it kept them even though for years they had kind of been on the back burner for tax planning because they were pretty much a break-even company. And so I think that conversation can really play in, but it requires looking at it holistically and not just going, here's what I'm trying to sell you today.
174 is a classic example today of how do we be more curious to be a better advisor to figure out what have you done over the not future years. What did you do over the last 3 to 5 years? Because we have all of this income getting added back, which drastically hurts their tax situation, drastically puts a pinch on cash flow. If we can go back and do a cost seg study and know that we can pull deductions forward, we just made that pain a little bit less painful at that certain time. And so it is it all starts with being curious, looking through the right information, and being bold to say, hey, look, this is a good strategy. And then backing that up with the CPA firm to say, yes, we have these deductions. Here's the utilization. Now let's walk step for step with this and figure out how now you get this money to figure out your investments and how you pay down debt or whatever those situations might be for those business owners.
Well, Mike, I appreciate the insight today. If there was one thing you wanted to leave people with as we walked away, what would it be?
Be curious. I think that'd be the biggest one.
I think that kind of sums it up, and it's really about being curious, not writing people off because of their size, and really looking at where we can provide opportunities. So, Mike, I appreciate you joining us today. Hopefully people gain something from it and are more interested in bringing up some of these opportunities to even some of their smaller clients where they might exist. Thank you, Mike.
Thanks, Dave.